Hey everyone, and welcome back to the channel. Today we're diving into the fascinating world of sovereign wealth funds, those massive investment pots managed by countries. These funds control trillions of dollars, and their investment decisions can move markets. But what can we, as everyday investors, learn from them? Let's find out. Sovereign wealth funds, SWFs, are basically state-owned investment funds that invest a country's foreign exchange reserves or other fiscal surpluses. Think of it like a national savings account, but instead of sitting in a bank, it's actively invested to generate return for the future. That we're going to look at 5 of the biggest SWFs in the world. 1. The Norway Government Pension Fund Global, GPFG. 2. China Investment Corporation, CIC. 3. Abu Dhabi Investment Authority, ADIA. 4. Kuwait Investment Authority, KIA. 5. GIC Private Limited, Singapore. First up, the big daddy of them all, Norway's GPFG. This is the world's largest SWF, managing over $1 trillion. It's fueled by Norway's oil revenues, and its goal is to secure the country's future public finances. The GPFG focuses on long-term returns and invests heavily in highly liquid assets like stocks, bonds, and real estate. About 70% of its assets are in the stock market, spread across numerous countries and industries. That what's really interesting is their commitment to ESG, environmental, social, and governance standards. They actively divest from companies with high carbon emissions. Since its inception in 1998, the GPFG has averaged around 6% annual returns. Of course, this fluctuates with the global market, especially the stock market. Their massive size and global diversification have a big impact. When a fund makes big asset allocation changes, it can affect market prices. Also, their ESG focus is pushing companies worldwide to improve their sustainability practices. Next, we have the China Investment Corporation, CIC. Established in 2007, CIC manages around $1 trillion. Primarily from China's foreign exchange reserve, the CIC takes a more active approach, with investments spanning stocks, bonds, private equity, real estate, and commodities, often in overseas markets. They're more likely to engage in direct investments and partnerships with private equity funds, especially in emerging markets and high-growth sectors. Since 2007, CIC has achieved an average annualized return of about 9 to 10%. This is largely due to their investments in emerging markets and high-growth industries, particularly private equity and infrastructure. CIC's investments have a significant impact on emerging markets, supporting Chinese companies' globalization and influencing global capital flows. The Abu Dhabi Investment Authority, ADIA, manages around $700 billion, derived from Abu Dhabi's oil revenues. ADIA invests globally across various asset classes, including stocks, fixed income, real estate, infrastructure, and private equity. They favor a more conservative, long-term investment strategy, focusing on lower-risk assets with stable returns. ADIA's annualized return is around 6 to 8% on average. As one of the world's largest SWFs, ADIA has a significant impact on real estate, fixed income, and private equity markets. They are a major investor in international real estate projects and hold substantial positions in fixed income markets, influencing global bond yields and capital flows. Established in 1953, the Kuwait Investment Authority, KIA, is one of the oldest SWFs, managing approximately $750 billion, mainly from oil revenues. KIA operates 2 main funds: the General Reserve Fund, GRF, for government fiscal needs, and the Future Generations Fund, FGF, for long-term growth. The GRF is more conservatively managed, while the FGF pursues higher risk, higher return investments. KIA's long-term annualized return is around 7 to 9%. As a long-standing SWF, KIA's investment strategies tend to have a stabilizing effect on markets, particularly in commodities like oil. They also provide significant capital support for global infrastructure development through private equity and infrastructure project investments. Finally, we have GIC Private Limited, Singapore's primary SWF. Managing over $300 billion from Singapore's foreign exchange reserves, GIC focuses on long-term value investing and flexible asset allocation, investing in stocks, bonds, real estate, and private equity. They seek a balance between stable returns and growth opportunities, with a preference for value-added assets. GIC's long-term annualized return is around 4 to 5%. GIC's stable investment strategy and diversified allocation allow the fund to obtain steady returns in global markets. The fund favors long-term value investments, especially in Asian markets, and actively participates in global private markets and infrastructure investments. Okay, so we've looked at the big players. But what can we learn from these SWFs and apply to our own investment strategies? Quite a bit, actually. Here are some key takeaways. Diversification is key. SWFs spread their investments across different asset classes and geographic regions to reduce risk. We can do the same by investing in a mix of stocks, bonds, and real estate, and considering international exposure through ETFs like the MSCI World ETF. Think long-term. SWFs focus on long-term growth, not short-term market fluctuations. We should adopt a similar mindset, investing in high-quality stocks, bonds, or ETFs, and holding them for the long haul. Consider a S&P 500 ETF or blue-chip stocks. Manage risk. SWFs adjust their asset allocation based on economic conditions and market risks. We should also adjust our portfolios accordingly, perhaps using a core satellite strategy with a stable core and higher growth satellite investments. Consider ESG. SWFs are increasingly incorporating ESG factors into their investment decisions. We can do the same by investing in ESG funds or ETFs like the MSCI ESG Leaders ETF, focusing on companies with good environmental and social governance. Explore different markets. SWFs invest in private equity and emerging markets for potential high returns. We can consider similar investments through ETFs like the iShares MSCI Emerging Markets ETF, but with caution and awareness of the higher risk. By understanding how these massive funds operate, we can gain valuable insights into building more resilient and potentially more profitable portfolios. So there you have it. A look into the world of sovereign wealth funds and how you can apply their strategies to your own investments. Don't forget to like this video, subscribe to the channel for more investing insights, and leave a comment below with your thoughts. Happy investing!